didn't happen with fireworks. It didn't happen with a headline screaming across every screen in the world. It happened quietly, beneath the surface, in the places where almost no one is looking right now. Silver just crossed a threshold that very few people understand. But the ones who do, they're already moving. Because something unusual is happening in the silver market right now. Vault movements are tightening. Physical demand is quietly accelerating. Futures positioning is shifting in a way that doesn't match the public mood at all. And when you put all of it together, it starts to look less like a normal market cycle and more like the beginning of something far bigger. A wealth transfer doesn't start when everyone notices it. It starts when almost everyone is looking the other way. And right now, that might be exactly what's happening. Before we go deeper, if you're watching this and you want to stay ahead of these kinds of shifts in metals, macro trends, and hidden market movements, make sure you're subscribed. Because what you're about to see is not something you'll hear explained clearly on mainstream financial media until it's already too late. Now, let's slow this down and really look at what's unfolding. Because there's a pattern forming in silver that experienced market watchers are starting to recognize. Not as hype, not as speculation, but as structure. And structure is what matters when markets begin to reprice reality. For years, silver has been suppressed in perception. Not necessarily in theory, but in behavior. Price movements have often lagged behind inflation pressure, industrial demand growth, and monetary uncertainty. While gold has been treated as the headline metal, silver has been quietly building tension underneath. And tension in markets does not disappear, it releases. But here's where things get interesting. In the last stretch of trading behavior, we're seeing signs that physical silver demand is beginning to disconnect from paper pricing mechanisms. That's a subtle statement, but it carries weight. Because when physical demand starts overriding paper sentiment, the rules begin to change. And there's one detail almost nobody is talking about yet. The spread between perceived availability and actual deliverable supply is tightening in a way that historically precedes aggressive repricing events. Now, don't rush past that, because this is where the story of a wealth transfer begins. Think about how most people interact with markets. They react to price charts. They react to headlines. They react after moves already happen. That's the retail side of the equation. But behind that layer, there's another flow entirely. Institutional positioning, long-term accumulation, strategic hedging, physical allocation decisions that don't show up in social media or daily news cycles. And that flow has been shifting. Slowly at first, almost invisible, but now becoming more noticeable in the behavior of premiums, delivery pressure, and contract roll dynamics. There are analysts who have tracked silver cycles for decades, saying something important is forming beneath the surface again. Not a prediction of collapse or explosion, but a structural imbalance that tends to resolve violently. And here's where emotion starts to creep in, because once you see it, you can't unsee it. You start to realize that silver isn't just a commodity. It's a pressure valve for global uncertainty. It reacts when confidence in systems starts to wobble. It reacts when liquidity expectations shift. It reacts when investors quietly begin asking the same question at the same time. What is real value right now? And that question is spreading. Not loudly, not dramatically, but steadily. Now let's bring in something important. In previous cycles, similar conditions didn't resolve slowly. They resolved in bursts. Sharp repricing events where late participants rushed in after early accumulation had already taken place. That's the part most people miss. The biggest moves in silver history haven't started with excitement. They've started with disbelief. Right now, disbelief is still present. Most investors are still focused elsewhere. Equities, AI, crypto volatility, macro headlines. Silver is not in the center of attention for the average market participant. And that's exactly what makes this stage so sensitive. Because when attention is low, but structural pressure is rising, the shift is often faster than people expect. But there's something even more critical developing behind the scenes, a divergence. On one side, paper pricing remains influenced by short-term liquidity conditions and trading flows. On the other side, physical demand from industrial use cases, renewable technology expansion, and strategic reserve interest continues to build quietly. And when those two forces move in opposite directions for long enough, something has to give. Now, here's a question for you. And really think about this for a second. If a market is showing signs of tightening physical supply while sentiment is still neutral, do you think price adjusts slowly to balance it? Or does it eventually snap to a new equilibrium faster than most people can react? Because that answer determines whether someone sees opportunity or watches it after it's gone. And this is where the tension builds. We're not at the explosive phase yet, but we might be entering the compression phase right before it. Think of it like a spring being slowly tightened. Each rotation doesn't look dramatic, each move seems manageable, until suddenly it isn't. And in silver history, those moments have produced some of the most aggressive wealth transfers between early accumulators and late entrants. Now let's pause on something subtle but extremely important. Smart money doesn't chase narratives. It accumulates during disinterest. It positions during uncertainty. It builds exposure when liquidity is quiet and emotional participation is low. Retail behavior tends to do the opposite. It waits for confirmation. It waits for headlines. It waits for movement that feels safe. That gap between early positioning and late confirmation is where wealth transfer happens. And right now, that gap might still be open. But it's not staying open forever. Because once momentum shifts in a commodity like silver, it doesn't usually crawl. It accelerates. And acceleration changes psychology faster than fundamentals alone ever could. People don't just see price changes. They feel them. And once they feel them, behavior changes rapidly. Fear turns into urgency. Hesitation turns into chasing. And chasing is what completes the transfer. Now, there's another layer here that makes this moment more interesting than previous cycles. We are not in a simple supply-demand environment anymore. We are in a multi-pressure environment. Industrial demand is structurally linked to long-term energy transition trends. Monetary uncertainty is layered on top. And global liquidity conditions are far more sensitive than they were in past decades. That combination creates what analysts sometimes call a stacked demand environment. It doesn't resolve cleanly. It builds pressure until price becomes the release mechanism. And if silver starts to move under that kind of pressure, the reaction can be disproportionately fast compared to expectations. But let me slow this down for a moment, because this is where most people misread what's happening. They think big moves come from big news. In reality, big moves often come from quiet accumulation meeting silent constraint. And right now, constraint is the keyword. Because while the surface looks calm, the underlying structure is tightening. Deliverable availability is not expanding at the same pace as perceived liquidity. And when that gap persists, markets eventually reprice aggressively to correct it. But here's the part almost nobody prepares for. The early phase doesn't look like a breakout. It looks like nothing is happening. That's the psychological trap. Now let me ask you something again. Would you recognize a major shift if it didn't come with noise first? Or would you only react once it was already visible to everyone? Because that distinction is what separates positioning from reaction. And reaction is always more expensive. Now imagine what happens if silver begins to break through psychological levels that have held for a long time. Not just technically, but emotionally. Levels where traders start to reconsider long-term assumptions. Levels where hesitation turns into participation. At that point, it's no longer about analysis. It becomes about flow. And flow is what drives acceleration. We've seen versions of this before in historical silver moves, where once resistance gave way, price didn't just move higher. It expanded rapidly as sidelined capital rushed in to avoid missing the move. And that's where the real wealth transfer becomes visible. Not in the beginning, but in the acceleration phase. Now here's the hidden signal I mentioned earlier. It's not just one indicator. It's the combination of tightening physical availability signals, persistent demand resilience during uncertainty, and positioning behavior that suggests accumulation rather than distribution beneath the surface. Individually, none of these are explosive. Together, they form a pattern that has historically preceded major repricing phases. But again, timing is everything. Because even when the structure is forming correctly, markets can remain quiet longer than most people expect. And that quiet phase is what tests conviction. That's why so many miss it. Not because they lack information, but because they lose patience. Now step into the future for a moment. Imagine what happens if silver does begin to reprice aggressively. Not slowly, not gradually, but in waves. The first wave pulls attention. The second wave pulls capital. The third wave pulls fear of missing out. At that point, the narrative changes completely. What was once underpriced industrial metal becomes critical scarcity asset. What was once ignored becomes urgent. And when urgency enters the market, valuation expectations stop behaving normally. But before any of that can happen, the current phase has to complete. The accumulation, the tightening, the silent repositioning. And that's where we are right now. Some participants are already moving as if they can see it clearly. Others are still waiting for confirmation that may only come after the move has already begun. So I'll leave you with this thought. If this truly is the beginning of a structural shift in silver, the question is not whether it will eventually become obvious. The question is whether it is already forming while most people are still waiting for clarity. Because in every major wealth transfer in history, clarity came last, not first. If you're seeing this early, you're not late to the conversation. But the window between recognition and reaction is where the real difference is made. Let me know in the comments what you think happens next. Do we see a controlled build-up first, or an aggressive breakout phase that catches the market off guard? And stay tuned, because if this structure continues to develop the way it's starting to look, the next phase could be significantly more intense than what most are positioned for right now. Subscribe if you want to track this unfolding in real time, because this is not just a market move anymore. It's a shift in flow, and once flow changes, Everything changes with it.